Well, good afternoon and welcome to our webinar, which is going to be focused on and around the mid-year market check-in. My name is Scott Kosek. I'm the Director of Learning and Development here at Union Savings Bank, and I'll act as the moderator for our webinar today. You are all in for a treat. Those of you that are joining us, we had a number of folks register for this. We have two expert speakers that are going to provide some insight on around the market and some geopolitical issues that have been happening as of late. And without further ado, before I introduce our speakers, just a couple administrative notes. You will be in look and listen only mode for the duration, which simply means we can't hear or see you. However, questions are encouraged to make this interactive. If you have questions for either of our two speakers, definitely just log those in chat and we'll pause periodically to field those questions as we go. Secondly, right at the conclusion of the webinar, there should be a link that pops up in your browser as soon as we conclude with a brief 5-question survey. We'd love your feedback. One of the questions will ask you, what you thought of the webinar, and then if there's some future topics of interest that we should consider for a webinar in the future. In addition to, if you would like to speak with one of our folks in the wealth area about your personal needs, there's an opportunity for you to respond in that way. So without further ado, it's my privilege to introduce our first of two speakers, Keith Wirtz. Keith.
Great, thank you, Scott, and I appreciate it. Good afternoon, everyone. If you can advance to the first slide, Scott. Just a standard disclosure statement. The things I'm going to discuss today are items and issues that we're thinking about. It's in conjunction with how we're looking at our client accounts, and it's because we have a perspective about our client accounts. I would encourage you to consider this information, but not advice that you should act on without at least consultation with your financial advisor. So just wanted to at least touch on that before we get into our topic for today. On the next slide, the whole discussion centered on the macro picture, the big picture of things. And as you can appreciate, we're halfway through the year now, so it's a good time to at least call time out. And let's focus at least over the last 6 months. What are the big drivers on a macro basis that might be influencing the capital markets, influencing how we're looking at investments these days? And we've got a list of at least 4 big picture items that's on this slate. And wanted to see, before I begin, which of these would you, the audience, find perhaps most important or at the top of your list that we should be focused on this afternoon? And so let me pause. I don't know, Scott, if this is the time for the question, but just wanted to find out what seems to be most important on the minds of the people attending this call.
Absolutely. Yep. The votes are coming in. We'll leave it open for about 30 seconds. Let everyone have an opportunity to participate in this poll. Keith, you were muffled just for a second in the very beginning, so I'm not sure if there's anything paperwork near the microphone or just as a heads up. You sound great now, but there was a moment where it was muffled.
Okay, thank you.
Welcome. All right, looks like we have roughly 80% of the vote in, another 10 seconds, and then we'll share these results with all of you. All right, we have a really nice sampling. I'm going to go ahead and end the poll and share the results with you.
I'm curious. What is it? Well, it seems like there's a distribution that's pretty evenly divided. Probably the biggest issue is the trade policy. And the good news is we're going to start on our discussion this afternoon, and that's going to be our first topic, actually. That, to me, was probably the biggest surprise of 2025, was the trade policy that was unfolded for the country with the change of administrations. And I think it caught me off guard. It caught Wall Street off guard. I put in some summary bullets as to what I'm addressing. The president took office January 20th, and one of the first executive orders he signed was an instruction to his secretaries to go back and develop a memorandum to his desk, considering trade practices and other issues that might affect their area of responsibility. He wanted to have those by March, such that he could assemble those into a policy that he wanted to put forth by April. And that all came in, and I think at that time, Wall Street was thinking about what is the new direction we're going with trade policy. What's to what extent are we going to see tariffs as an application of this new policy? Our expectation was that tariffs were going to be a part of the program. It was going to be incremental, and it was going to be centered on the use of tariffs as a leverage device, much like we saw in his first administration. Make no mistake, April 2nd, when he came out with the announcement of what the new direction was for trade policy, and how he's going to use tariffs, it was a surprise. It was a much larger policy initiative than we expected. It was universal. He was looking to apply a across the board 10% tariff for all countries that do trade with the U.S. He was looking to increase incrementally the tariff obligations of certain countries based on their trading balances with the U.S. And some of those tariff announcements suggested that there was going to be as much as a 50% tariff applied to imports coming from certain countries that we do business with. It was much bigger, much broader. It caught me off guard. It caught Wall Street off guard. And in fact, we saw what happened in the capital markets. I'll get into that later, but we had a very sharp and negative response from the marketplace when that large program was announced. It was like a major blast to the markets and to corporations and countries. Fortunately, within 7 days, we got another announcement. There was a 90-day pause on the incremental reciprocal tariffs, this measure that was used, calculated based on trade balances. That was the first signal, at least to me, that what we were witnessing in real time was a public negotiation with all the countries that the U.S. has business with, and that the massive tariff announcements that were put forth on April 2nd, that wasn't where we were going to end up. We were going to end up somewhere else, still to be determined, but there was going to be room for negotiation. And so that gave me a lot more comfort and confidence of what was going on. But I have to confess, the April 2nd announcement intimidated me as it did the markets. If we turn to the next slide, let's put some context around this. We've had tariffs here in this country for hundreds, for decades, if not over 100 years. In fact, that's how the country financed its affairs prior to the 1913 income tax legislation. Last year, in 2024, the country actually experienced $3.3 trillion of imports of goods into this economy. And of that, we averaged a revenue stream and a tariff implication that on average, on a weighted basis, was 2.5%. So we had tariffs in application prior to the new administration. It's just that April 2nd announcement was so substantial that it was going to be a big paradigm shift from what we had experienced. I looked into different types of research, and I rely on information that comes from the Tax Foundation. And one of their recent white papers tried to put an estimation as to the policies being expressed recently. Their estimate on the tariffs, if they reflect an adjustment based on behavioral changes, they estimated that the new policy direction might indicate an average application of tariffs north of 12%. That's a lot larger than the 2.5% that we experienced in 24. However, there's a legislation that is in place. It's a legislation related to how the president applies and uses emergency powers. And he used that particular delegation of power from Congress to approach this new tariff policy. And that's now being challenged in the courts. There are going to be aspects of the president's tariff policies that are going to be challenged through the courts, and it's going to be adjusted, I believe, as a result of his strong use of that emergency power. As we sit today, and everything I've read, my best estimate is that we're going to finish the year and we're going to go forward with a weighted average tariff application for goods coming into this economy somewhere around 7% is likely where I think we're going to end up. You can turn to the next slide. Now, I talked about last year we had tariffs before the change in administrations. You can see the line on a monthly basis for 24. It's the blue line. When the year is over, the U.S. government had sourced about $79 billion of tariff revenues to the Treasury. This year, and that's the yellow line, you can see the effect of the policy change that took place in April. The line is starting to skew much higher. As we look through the end of May, the economy had generated over $60 billion of revenue. And on that path, it looks like if you extend it out and do an extrapolation, we're on pace to do about $180 billion of revenues from the tariff policies that have been expanded in 25. And so that's the revenue stream that's coming to the U.S. government. And I do believe the president has a desire to elevate the revenues from tariffs for the federal government, and that's going to be permanent, at least through his 4-year administration. And it wouldn't surprise me to see us somewhere closer to the 150 to $200 billion kind of level of revenue stream coming off of tariffs. On the next slide. Before I go there, let me just ask, if there are any questions from anyone, I'd welcome any questions if you want to do those through the chat box on the issue of tariffs. It's probably the biggest event in my mind. It's disrupted the markets, and it's put into question the macro condition of the U.S. economy as well as Europe and our trading partners. So it's a big deal, but I'd welcome any questions from anyone if you might have them on the tariff issue. I think probably the closing comment I would make, because of the fact that we've seen the president modify his position and such, that's given, I think, some level of, it's moderated the anxiety that was going on with tariffs. There's no doubt in my mind, Wall Street's not used to tariffs. Wall Street doesn't like tariffs. But I think we're going to moderate towards something that's going to be much less extreme than what we saw in the April 2nd announcement. Now, the effect of tariffs, if you go back to the previous slide, clearly the markets convulsed when we had the news on April 2nd. In fact, we had a sharp drop in the marketplace, and it rippled not only through the equity markets, the risk assets, it rippled through the credit markets as well. It touched almost all aspects of the capital markets. On the follow-up slide, the next slide, Scott. I wanted to give you just an image of that volatility. And what you see on the right, the graph, that's the S&P 500 price level graphed for the year-to-date number. And you can see in the middle of that graph, that huge slope down, the big slide down, that's April. That's when the announcement came. We had the huge drop in the marketplace. Fortunately, subsequent to that, though, with some of these adjusting positions on tariffs and some of the new rhetoric coming out, we've seen a recovery in the stock market. But the one thing I would say is that we had what would classically be a bear market condition that took place for about a month. And we've entered what I would describe as a new bull market circumstance. We're now in a new bull market, and the numbers on the left is my attempt to try to illustrate that. The S&P 500 on a price basis when last year finished was at 58.81. We hit an all-time high of 61.44 in February on the 19th. And at that time, we had a year-to-date return on the S&P 500 of 4.47%. We started to move in different directions, and then the April 2nd announcement took place. We hit a 2025 low on April 8th at 4,982. From the high of February to the low of April, we dropped almost 19% in the S&P 500. The NASDAQ actually dropped more than 20%. So we had a huge sell-off. It was a sharper correction than what we saw. It reminded me of the March 2020 period when we had the COVID pandemic moment hit the shores. However, with the changing positions and with a time to reflect on what it meant for company earnings, what it meant for the economy, et cetera, we got a massive recovery. And as we sit today, we're on the doorstep of reaching those previous highs. If I try to capture through yesterday's close, the S&P closed at 6,092. From the low, that's a rise of 22% plus. In textbook terms, we had in my mind, we reached a bear market and we rebounded off that into a new bull market condition. Year to date through last night, the S&P 500 on a price basis is up over 3.5%. So we've really gotten past that first negative convulsion that took place in the marketplace. If we turn to the next slide, the market and the strategists who focus on the markets and try to provide projections also had a convulsion. And what you'll see in this graph, this is a graph showing sell-side analysts and forecasters and what they were looking for as an S&P 500 target when the year was over this year. And when the year started, the average of these forecasters, when you blend it together, was a price target of 65.50 on the S&P 500, looking for almost a 10% return on the stock market, a little better than 10% return. When that March or April 2nd announcement came, the analysts and the strategists actually dropped their targets, dramatically. In fact, at a rate faster than what we saw in the pandemic. They took their targets down so low that the average moved down to 6,050 in April. And I've given you an example, a slice of some of the forecasts. Yardini Research, for example, took their forecast year-end target of 7,000 down to 6,400 in April. JP Morgan took their 6,500 target down to 5,200 for the S&P in 25. And you can see where Goldman Sachs took theirs down to 5,700. Here at our organization, I left our target in place. I was somewhat frozen trying to understand the news flow and what was going on, so we didn't make any adjustments. However, as the news continued to flow and as people got more comfortable with where things were going, the strategists on Wall Street readjusted their targets again. They went right back. So it was almost like a Super Bowl bounce off the ground. They took their numbers down and they brought them right back up. And I tried to display where these particular strategists, where their numbers stand as we sit today. Based on my target of 6,400, that would suggest a full year return on price basis of 8.8%. And then you'd add on dividends, maybe 1.25% on dividends. So I'm still of the mindset we're going to achieve a 10% plus return on the stock market this year. But it's not been a fun ride. I mean, it's been like a roller coaster. If you turn to the next slide, credit markets went through a complete gyration as well. And I wanted to show you the shape of the yield curve using U.S. Treasury yields. The black line shows where U.S. Treasury yields were when the year started. On the left-hand side, that's 1-month Treasury yields. Over on the right-hand side, the black dot on the far right would be the 30-year bond yield. And you can see as of the 20th of June, where yield stood 6 months later, or 5.5 months later. Yields have moved around a little bit, and where they've moved the most dramatically has been in the belly of the curve, the 4, 5, 6, 7-year area, the maturity of the yield curve. The yields there have come down, which to me signals that capital is flowing shorter into the shorter maturity segment of the credit markets, and they're selling off some of their longer duration exposure to try to provide a little more of a defensive stance given the uncertainties of this year. So we've had a massive adjustment in the yield curve. This yield curve is going to continue to go through adjustment, and it wouldn't surprise me to see a complete positive slope when the year is over, and that's going to be achieved when the Federal Reserve eventually starts to cut the policy rate on the left-hand side. The only reason why 1 and 3 month interest rates for cash are still remaining in the 4% plus range is because of Fed policy right now. Once that starts to move further lower, which I anticipate it will, we're going to see this curve continue to steepen out. If you turn to the next slide, a third topic, and this again is an important one for all of us, it's the inflation topic. It influences the credit markets, and that influences risk assets and how you price risk assets. And we've gone through a period of high inflation that was the surprise of the last, say, 3 years. As we sit in 2025, there's been some good news, surprisingly good news, and that's the reason I've got this topic on the list of surprises. The red line shows retail CPI as they've been reported month by month, and these are 12-month look-back numbers for the year. And you can see that for the month of March, April, and May, the retail CPI has stayed static at that 2.8% level. It's been static and consistent, but it's below 3%, which is really good. The blue line is the core component of CPI. It X's out some of the other aspects of that, and that's down in the 2.4, 2.5 range. And so we've got inflation below 3%, and it looks to me if you were to X out the shelter component, we would have a retail inflation level that's below 2% right now. So we've had really good news on the inflation front. And the question that everyone's trying to answer is what's going to happen over the next 3 and 4 months? Are we going to continue to see benign inflation conditions, this very moderate pace of price growth, or are we going to have a surprise coming from the tariffs? That's the big question. And that's the reason why the Federal Reserve's not taking action right now with the policy rate. They want to see more evidence of what the effects of tariffs will be on the inflation issue. And so they're going to want to see more data before they take action. And I think the next 3 months are going to be really important. The June monthly figures on inflation, the July and the August numbers are going to be really, really important. If you turn to the next slide, you'll see not only is the data important, but the expectation about inflation is important as well. And what this graph shows are survey responses coming that the New York Fed puts out every month. and they survey consumers. They ask the simple question, where do you see inflation 1 year forward? Where do you see inflation 3 years out? And if you think more medium term, where would you guess inflation might be 5 years out? And these are the graphs for those three different time frames. And right now, as we sit today, the forward expectations hovering around that 3% kind of level. And it's been coming down month by month this year, particularly when we've had the last three CPI reports. That's been very positive, and that's crept into the sentiment of households and of business people. That's all really good news. And so it's something that I watch, the sentiment surveys on inflation, because that influences how people behave and how they spend money. So it's an important figure to watch. It looks like that's pretty tame as well. And the last slide here on the inflation front, it goes to the Fed. The Fed's got 4 more meetings this year. The next one's in July. Then we have a September, October, and December meeting. And at this juncture, as I described, I think they want to see 2 or 3 more months of data before they may take any change in their policy. They've had a policy with the Fed funds policy range of 4.25 to 4.5 since last December. They haven't done any adjustments to that stance since last year. It's my judgment, however, if we get decent and benign inflation reports over the next 2 and 3 months, they're going to poise. It'll be appropriate for them to consider a rate reduction. And I say that partly because if we're in an inflation environment that's in the mid twos, having a policy cash yield that's in the mid fours is somewhat restrictive. There's too much of a positive real spread off the inflation measure, and I think they're going to want to pull that down. It's start to work against the economy, and there's no reason for them to maintain that level on the Fed funds rate. But I think they're going to need 2 or 3 more months of information before they consider taking a reduction action. I think, in my personal view, is before the year is out, we're going to see 1, if not 2, rate reductions. I think we may end up with a policy rate in a range of 3.75 to 4% to start next year, and that's largely because I have a fairly positive view on the inflation front. I think we're going to see inflation, retail, and wholesale continue to show good evidence, and I think that's going to give them the courage to change their policy stance. The last item, big picture item, is the most recent, and it's been profound, is the Middle East item. And I wanted to start with this graph of the Brent crude futures contract, the August contract. It's a contract showing for the month of June, and you can see when the first actions in the Middle East by Israel to start to attack Iran, we got a huge jump in oil prices across all fronts of energy and oil prices. And that's what you would expect. The idea that there's going to be a disruption of Iranian oil to the marketplace, there's going to be a supply disruption, and it's just a natural impulse. We saw a big jump in energy prices. However, within the last 2 and 3 days, those price levels have come way off. We're almost back to where things were prior to the hostilities. And what the market's pricing and signaling, in my estimation, is that what has taken place over the last 7 and 8, 12 days, they're looking through that, and they're considering that to be a resolved matter. And they're not expecting the Straits of Hormuz to be blocked. We're not going to see disruptions to the supply of oil to the marketplace. If you turn to the next slide, the events have been really startling. No one expected it. And I put up here at the top of the slide what the comments that I developed with my 25 outlook back in December. And it was our view back in December that for this year, the big change with the new administration coming in was going to be the simple fact that the new president was going to allow Israel to take more substantial action. He was not going to restrain them from things they wanted to do. And I think that's been borne out. I also expected that we were going to see a renewal of the tariffs or the sanctions on the country of Iran, and that as it relates to our country's policy towards Iran, it was going to be a little more of a pressure policy to be applied on Iran to get them to change their behavior. What I did not expect was what has transpired this month, that Israel took military action, and then subsequently we followed up with the actions we took last weekend. All of that was a big surprise. As we sit today, it feels like the markets are looking past all of this, it feels, like we're really fortunate that perhaps the events that have unfolded may be the majority of the conflicts that we've been worried about. You see that being signaled through the marketplace. We've seen risk assets like stocks and bonds rally big time. We've seen oil prices drop. We've seen gold, dollar, and volatility measures come down as well. The markets, at least in my mind, are signaling that these events are largely behind us and they're over. And the only, I think, broad question that I keep asking myself, and I've been thinking about things over the last 5 days, because of the events that have transpired the last 7 days, could we be looking at the closing chapter to what I call the October 7th conflict that took place in 2023? That would be really good news if there was that we've reached a settlement of peace, and maybe there's going to be some things worked out between the Gaza Strip, the Gaza region, and Israel. I even more broadly been asking the question, and it's way too early to come to any kind of an opinion. Are we looking at a different circumstance as it relates to Iran and the rest of the world? Could the Iranian aggression that emanated from 1979 on, particularly as it relates to the U.S., could that whole period of time that's been one of aggression, could that whole chapter be closing, and we may be entering a new paradigm or a new chapter? I don't know, but those are the thoughts that have been stirring through my mind, and it's really important to me. I think it's something that everyone's asking. So those are the geopolitical issues that I had. I don't, Scott, if you want to flip to the next slide. I wanted to end on my outlook as we sit here mid-year. Looking at the fundamentals for the U.S. equity markets and for the markets in general for stocks, I wanted to display to you, and you'll see that in the table in the upper right-hand side. These are today's earnings estimates for the S&P 500 companies on a per share basis. Wall Street's expecting this year for U.S. companies to generate year-over-year profit growth approaching 9%. Keep in mind, when the year started, their estimates were much higher. They were looking for about a 15% profit growth experience this year. They pulled it down. I think they pulled it down to an extent because of the tariff issues. And I think that would suggest to me, at least, that these tariff prices that have been levied on imports, that not all of that price increase is going to be passed through to the ultimate consumers. That at least for those companies in the U.S. that have those issues, they're going to absorb some of that change in costs, and margins are coming down. That's somewhat how I'm reading that picture. For the full year this year, looking for 8.9% profit growth on revenue growth of about 5%. Looking for next year, and this is what I think the stock market's pricing in as we sit, looking for EPS growth next year somewhere in the 13 to 14% range. And so this profit picture that's quite bullish remains intact for next year. And that's one of the reasons why the foundations of the stock market, why the market's doing so well. If you turn to the next slide. With that in mind, as the fundamental backdrop for stocks is really positive. I think for investors, this is a year and next year, we're going to make money in the stock market. So I'm particularly, I remain bullish on the stock market. The themes that we're employing for our clients as we talk with them and based on their circumstances, we are wanting to embrace more of a U.S. bias at this time. The foreign markets have done quite well. We're taking kind of a counter move. We want to embrace the U.S. marketplace as a bias in our equity exposure. And we're starting to look at the small cap segment of the marketplace because of the valuations, the cheapness that exists there. The reason why, beyond just equity fundamentals or company fundamentals that I'm bullish, there are certain policy changes that are going to be tailwinds to this economy. The deregulation push will translate into, I think, a faster commerce or faster economic condition. Congress is right now working on tax legislation, which is hugely important. Our next speaker, Brandon, is going to touch on that and some of the details. We have to see that passed if to maintain the positive tone in the capital markets. And then lastly, I think we're seeing a shift in terms of the rate of spending growth in the U.S. government. That's all of those three factors, in addition to the fundamentals of the U.S. stock market, serve as my foundation as to why I'm pretty bullish right now. I think recession risk here in the U.S. is very low. I think inflation's becoming a good story, and I think we're going to end the year with CPI inflation somewhere in the mid twos. I think the Federal Reserve is going to consider, as a result of that information, one or two rate cuts on the front end. So cash yields are going to come down. We're going to see the U.S. Treasury curve normalize, which means short rates are going to yield less than longer rates. If you take maturity risk, you're going to get compensated for that. And I still think we're going to see EPS growth this year, 8% plus, and that's going to be the basis for why I think we're going to make money in the stock market. Those are my quick and concise summaries as to why I'm bullish about both sides, the stock and bond market. For the bond market, I'd be encouraging clients, at least that we work with, where it makes sense, look more in the medium term in terms of maturities, and look at yield. Look for where you can capture spread or yield off the Treasury marketplace. I think that's going to drive returns going forward. I'm going to pause. I went through all of this information really quickly. Would love to try to address anyone's questions before our next speaker comes on while everything's fresh in everyone's mind.
As of now, it looks like the question queue is quiet. Doesn't mean you still can't ask questions prior to the end of the webinar. So certainly if you have those, go ahead and just log them in and we'll make sure to answer those before we conclude for the day.
Great. Thanks, Scott. Why don't we go ahead and then I'll introduce the next speaker, and I appreciate everyone's time this afternoon.
Okay. Great. Well, thank you everyone for joining the webinar today. My name is Brandon Angotti. I'm the Financial Planning Manager with the Wealth Group at Union Savings Bank. And today I'd like to take some time to talk about everyone's favorite topic, which is taxes and tax legislation. Specifically, I'd like to talk a little bit about the One Big Beautiful Bill that's currently in talks right now for possible passage. I wanted to really just kind of summarize the income tax and estate tax changes that I felt were most relevant to the audience we have in front of us today. So last year, prior to the presidential election, there was a lot of questions around what is going to happen with the Tax Cuts and Jobs Act. It was set to expire at the end of 2025, and if nothing was done, that was the case. There are going to be big changes to tax rates, to estate taxes. We got a little bit of clarification once we found out the results of the presidential election late last year. And now with the One Big Beautiful Bill, we're getting even closer to a possible decision and some true clarity to start doing a little bit of planning going forward. There was a lot of planning and discussion last year of, if tax rates go down or go back up, what should we do? If estate tax exemptions go way down, how do we plan for that? So now we're getting a little bit closer to, some definitive information that we can work off of. So I wanted to start talking about some of the income tax changes that we see ahead. Again, these have not fully passed yet, but it's getting closer, and these are most likely what will happen once everything is fully enacted. So the first piece is a permanent extension of tax rates and brackets from the 2017 Tax Cuts and Jobs Act. So if you remember, this is where they eliminated the top tax bracket of 39.6% and replaced it with the 37% tax bracket. Additionally, now a lot of people that are in the 24% tax bracket previously were split between 28 and 33. So it was a nice, lowering of taxes for individuals. The other piece is that they're planning to permanently extend essentially the double standard deduction, which is their plan to reduce itemized filers to just make tax filing simpler on a year-to-year basis. They're discussing adding a $4,000 standard deduction for some seniors with certain income restrictions. So that's something that may go through. And they also are completely getting rid of personal exemptions, which we obviously haven't seen in quite some time. Some positives for the parents out there. They are planning to make a permanent child tax credit of $2,500 while President Trump is in office, and then it will go to $2,000 per child per year, and that will be adjusted for inflation after. A few items that got a lot of attention over the last few months was the possibility of them eliminating taxes on overtime pay and tips. And it looks like that will be at least temporarily instituted from 2025 to 2028. Another item that got a lot of attention was them talking about getting rid of taxes on Social Security benefits. And it looks like that was actually removed from the bill. So that is no longer likely to pass. Probably the most controversial piece of this bill has been the discussion around the SALT cap, which is the state and local taxes income deduction, which is essentially all of your state income taxes that you pay, property taxes on your home, on your car, used to be unlimited to an extent. I'm not going to get into all the details of that. But once the Tax Cuts and Jobs Act was passed, they limited it to $10,000 per year. So that really did hurt, some above average earners in high tax areas where maybe they have $15,000 in property taxes and $15,000 in state income taxes. So before they could deduct $30,000, and now they're saying, hey, now I can only deduct 10. So there's been, both sides of the aisle have been chiming in on this quite a bit. The new plan, as of right now, is to raise it to $40,000 for married filing jointly for taxpayers earning less than $500,000. So it's going to give a nice benefit to some of the more expensively taxed states, while at the same time not giving a massive benefit to the ultra high net worth, ultra high earners. That's why it's sort of limited to that $500K. And additionally, the cap and income limits will increase 1% per year for the next 10 years. So we can look out for that. Obviously, given that most of our audience is in Connecticut, could be a relevant change to most of you. Another interesting change is they're thinking about a deduction for auto loan interest, again, only during President Trump's term, and only on US-made cars with certain restrictions. They're thinking about a new tax credit for donations to scholarship granting organizations, and that will be limited to $5,000 per year per individual. And again, that's just a temporary adjustment. Finally, there's a lot to talk about here, but for the purposes of this slide, I'll just mention that they are planning to expand eligible expenses for both health savings accounts and 529 college savings plans. They want to encourage more people to put more money into these accounts. So they're making it a little bit more flexible in terms of what you can do with it, which I think is great. In terms of estate tax changes, again, this was something that was very controversial because if it had sunset, the Tax Cuts and Jobs Act sunset, we would have gone from the 14 million for individuals and 28 million for married couples in terms of their estate tax exemption back to about 5 million indexed for inflation, so 6 or 7 million. And that would be the plan if nothing was done. Now, assuming this bill is passed, starting next year in 2026, there'll be a permanent increase in the exemption to 15 for individuals, 30 million for married couples, and that will continue to be indexed for inflation annually. So that will continue to grow. It doesn't seem like there's any major changes being made to the annual gift tax exemption, which is currently $19,000 per year and is also indexed for inflation. So maybe we'll see an increase on that for next year. Finally, an interesting thing that's going through right now is the idea of the creation of Trump accounts to essentially create investment accounts for babies born between during 2025 all the way through the end of 2028. The way it would work is to be a $1,000 contribution into the stock market set up by the U.S. Treasury. Families have the option to add $5,000 per year to this account. Now, there are some restrictions in terms of how funds can be used, what they can be used for. This account is sort of best thought of as sort of the way that you use your health savings account, where it's certain eligible expenses. If it's not used for that, there are taxes and penalties. So some of the eligible expenses will be funds can be used for a home down payment, education, or starting a business. Once the child reaches 18, half the funds can be withdrawn with capital gains that are taxed as long as it's used for those qualified expenses mentioned above. If not, there'll be a 10% penalty on top. You have access to the full balance between ages 25 and 30 for those qualified expenses. And then after 30, these funds can be used for any purpose. So it's a good way to kind of give people a nice head start, get them invested in equities early on, and then when they reach adulthood, they should have a nice nest egg to fall back on to use for some qualified expenses. So that's everything that I wanted to make sure that I covered today. Again, that's a huge topic. There's a lot that can be discussed, but for the purposes of today's webinar, I wanted to stick to that exactly the way that it's functioning. So that's everything that I wanted to make sure that I covered. Here's our contact information. If you have questions, please put them in the Q&A, or feel free to reach out, send Keith and I an email, give us a call, and I will hand it back to Scott.
Excellent. Thank you so much, Brandon, Keith. Really great information shared with our audience today. There are a couple questions rolling in, so for those that want the benefit of these questions being answered, hang tight for a little bit. Additionally, before we have our speakers answer the questions, I am going to throw a link in the chat that I would encourage you all to click on to. That's a link to the YouTube page that our wealth group, pretty much on a weekly basis, puts out new content. So if you enjoyed some of the really good information that was shared today, on a weekly basis, various speakers from that area are putting out content on that link I just shared. So if you save that to your favorites or your browser, you can check on a weekly basis for new content. With that being said, I'm going to scroll up to the top to our first question. Are the Trump accounts tax deferred, Brandon?
Yes, they are if they're used for the eligible expenses upon reaching the appropriate ages. So, like I said, if it's up until 18, you can use the funds, but there will be some taxes on it. However, if you wait until 30, it is fully tax deferred. If you wait until 25, it's fully tax deferred if it's used for those eligible expenses.
Excellent. Looks like we have another question here asking about any other information for the senior deduction.
So it is going to be that $4,000, but it is limited to certain income earners. I believe it was $75K for individuals and $100,000 for married filing jointly to qualify for that additional $4K. Again, that number can change, but I would just recommend make sure that when you are filing your taxes in April, please ask your CPA, please confirm that, and then just make sure you're getting the best, most timely advice, because a lot can change between now and then.
Excellent. Looks like we have a number of great presentation. Thank you for the information, but we have another question here that reads, has there been any information related to COLA increases that you know about?
As it relates to Social Security cost of living adjustments, or if that's the question, typically every October they'll release what the cost of living adjustment will be for Social Security for the following year. As it relates to, I think I referenced quite a few times in the presentation that there will be index for inflation. So that will just every single year they will come out with what they feel is the appropriate inflation adjustment. That will be. It's not the same every year. It'll be adjusted based on what happens on the market.
Excellent. Thank you for that. Questions are just rolling in. Great question. So this one here reads, the big beautiful bill as it respects the passing of a working farm from one generation to another, as respects tax avoidance and transfer of the asset. So basically anything in that's going to help with that transfer.
I don't recall seeing anything specifically about that. I think the one thing that was sort of up for debate was for a while, and most likely relevant to this question is, are they planning to get rid of the step up in basis when property is passed from one generation to the next? I haven't seen anything lately of them talking about getting rid of that. There was some talk about getting rid of it or even limiting it. So I don't believe there should be any change in the step up in basis, if that's what you're referring to. Keith, do you have anything to add to that?
Yeah, the one thing I would add is that the lifetime exemption, the way you can pass down the current levels. What are the numbers? 13 million right now.
14 and 28 right now.
Yeah, and the fact that that's going to be likely retained in the bill, that's going to, I think, at least provide relief on a major asset like a farm.
Yeah, good point.
Very nice. We have another question here that reads, I think this might be a crystal ball prediction from you guys, but let's see. So in your opinion, do you feel the 4K standard senior deduction would somehow equate to the elimination or no tax for seniors at some point?
That might have been something that was added in to soften the blow a little bit to give them a little bit more of obviously it's pretty targeted to anyone collecting Social Security is obviously also going to be a senior. So yes, that could be something in there to assist with the fact that they couldn't pass the Social Security income being exempt from taxation. That's a great point.
Excellent. Looks like our final question in queue at the moment is there any change to the current tax-exempt income from municipal bonds?
I can answer that. The most recent I've read is that the exemption status of state issuance and local issuance bonds continues. There's no intention to modify or change that.
Okay, thank you. And it looks like there's a follow-up to the question that Brandon just answered. Is the 4K standard senior deduction based on per person, based on income level if qualified?
So it depends. If you're married filing jointly, it would just be both of your incomes combined, then it would be based off of that. And if you're single, it would be based off that. If you're married filing single, or married filing individually, that would come into play. But most likely, if you're married, it would just be the combined married filing jointly income that they would use to determine if you qualify for that additional deduction.
Excellent. Looks like we're caught up on the questions. Some really great questions coming in there at the end. Again, on the screen here is some really good contact information if you want anything additionally answered after we conclude this webinar. Hopefully you all saved that link I put in the chat. That's a great opportunity for you to see some more content via the YouTube channel for Union Savings Bank and the Wealth Group. I don't have anything else. Looks like we're all caught up on questions. So just one final reminder that if you could just take 2 minutes and fill out that survey, we'd love your feedback. Hope you enjoyed the content, and I hope you have a great rest of your week.
Great. Thanks, Scott.
Great. Thank you, everyone.
Bye-bye.